What's up, guys? Welcome back to DCA. I'm here with Mark from Upside Down Data, and today what we're going to be doing is talking about several things, but primarily we're going to talk about our new website that we released, polaritydigital.io. So I think what we want to do is kind of go over what some of the main features are. I think a lot of people have probably checked it out at this point, but beyond just looking at the main features, what we really want to do is kind of show you how you can use the website to actually benefit yourself as an investor. Because I think there are a lot of really powerful tools on the site that you can utilize. And, I understand that given the fact that there's what, 5 or 6 risk metrics on there, it can be overwhelming. So I think we're going to try and mostly show you how to distill that down and just sort of create a strategy for yourself that you can use without kind of getting bogged down by all the different information on there. So I think the site has something for everyone, no matter what type of investor you are. We have all of the price information, so you're going to get a lot of the same type of information on there that you would get by going to like CoinMarketCap or CoinGecko. um, we have all of the risk metrics. We have a charting system that you can use actually to create your own custom formulas. And, whatever you see on the site right now, we're actually still in our beta phase. We haven't even added a lot of the support for all of the different assets that we're eventually going to have. We're very soon going to be putting stock information, economic data, all of that into the dashboard so that you can utilize all of that in any way that you'd like. So I think it's a really powerful tool that you as the investor can use in order to broaden your investing education, I think. And, I think there's a lot of actionable information on the site that you can use to actually benefit yourself. So with that said, we'll also talk about the crypto market today. I think a lot has happened over the last couple of weeks, and a lot of exciting things have happened. We've seen a rally in we've seen the stock market rally. We've seen the Fed start to slow down. They haven't pivoted. Surely they haven't pivoted. In fact, I don't necessarily think a pivot by definition of them turning around and decreasing rates. I don't think that's necessarily on the horizon anytime soon. But we have seen the market react positively to a lot of the things that are happening. So at the same time, there's, you know, data coming out, like we've seen a lot of tech layoffs announced, and we can talk about how that's actually going to affect the market because, while some good things are happening, there may be some more bearish things happening in the market right now as well. So there's a lot to cover. I'm glad to be joined by Mark again. Him and I have actually been working on this site for, quite frankly, I think we started in February of 2022. And here we are in February of 2023. So it's been an entire year, a long journey, but we're finally off the ground after about 3 or 4 iterations of the site. So, we're happy to show you guys this tonight. So with that said, I'll pass it over to Mark.
Yeah, and I think Jay laid it out very well. I think the site is incredibly useful. We've been wanting to have a place where folks can come and see the data live, as things are happening and not just only through the videos. So I think the site really does a good job of that. And also letting you mess with the data yourself in the workbench, make your own metrics, things like that. We'll talk about that more in a minute here as we go. So I don't want to hold this up. So Jay, if we just want to go ahead and jump right into kind of showing off the site and some of the things we want to talk about, I think that makes sense.
Yeah, sure. So I'm just going to pull the site up here and, basically a lot of people have already seen this, so I won't spend a ton of time here. Um, when you come onto the site, previously you had to log in. Now we've actually integrated this where you just come over here to log in. And once you do that, currently, if you're new to the site, I think it's going to make you sign up or it will make you create a nickname. And that's because of the fact that we're going to be integrating some community features here, and I want people to be able to remain anonymous. So I don't want everyone to show their email. So we'll have that. You'll have a user profile, and something we're working on integrating right now is you'll be able to save your favorite assets. When we'll look at the workbench here in a minute, you'll be able to save your chart features that you set up. Basically, you'll be able to save the entire site to whatever your specifications are. So if you don't want to see you know, XRP or Litecoin or whatever, Bitcoin, whatever you don't want to see, you won't have to. And so it can just become a streamlined experience for you. So you'll get all of the information you want right away as quickly as possible. We don't want you to have to spend, 10 minutes going through the site searching for whatever it is that you're looking for. And just like when we look at the workbench, we don't want you to have to set up formulas each and every single time you come back onto the site. They should just be there and ready to go. One of the other things we'll be integrating is the ability to share whatever formulas you create. And, if you don't know what I'm talking about, that's over on this workbench here. You're actually able to create formulas without the need for knowing code. So, if you wanted to see the, the 20-week moving average, you would just type in the SMA and then whatever asset you wanted to apply that to, asset or indicator. So you could apply the SMA to any of the indicators, and then you would just type the number of days that you would want to apply the SMA to, in this case, 140, which is what we should use for a 20-week moving average for crypto, really, because it's traditionally people use a 20-week, but crypto trades every day of the week. So, I think this is a more sensible approach to that. So you just hit evaluate and draw, and there you go. You have your 20-week moving average. Okay. And the formulas get much more advanced than that, and we can talk about some of those in a bit. But the bottom line is you'll be able to save this. And then if you do create a formula, when I say a formula, realistically, what you can do here is kind of create top and bottom indicators, that type of thing. That's something that you'll be able to create on here. I think people will start to find, right now, I don't think a lot of people really get it because it's something you have to mess around with a little bit. But once we start adding in like on-chain data, once we have economic data, you'll see that you can start to actually create top and bottom indicators. And I think once people start to discover some of that, we'll start to see some interesting things being added. And we'll have a community site where you'll be able to show whatever formulas you found, and the community will kind of be able to discuss them, vote on them, decide what they like, that kind of thing. Over here on the main site, what we have is, so you'll come to the dashboard, and on the dashboard, you'll see that we have all the price information. You can select all of the different metrics we have, and we're actually going to get rid of the save button. So whatever you select, it will just automatically appear on there. So let's say you want to look at the all-time high and the drawdown from the all-time high. So you would just add those, you save them, and now you can see what the all-time high for the coin is, what its drawdown is, etc. Next to that, what we have are all of the risk metrics that we've created. So we have the UDPI metrics, we have the MBI, market bias indicator, the TCI, and the
momentum bias.
No, sorry. I say that every time. Momentum bias, yeah. And what you'll notice here is I understand that not everyone's going to know what all of these are, and it does seem like a lot, but there are videos right here that explain exactly what each of these does. In addition to that, you can see right next to it, there's just a brief text description. All right. So you're going to have all of your data right here. And something that I still don't think a lot of people know about is what you can do. Let's say you want to see in a chart the Bitcoin price versus the MDC. You just click the MDC and it automatically loads both of them for you. Okay. So you can just come in and see them right next to each other. So that's pretty much what we have on the market analytics page. And right now the market analytics include about 40, or I can't remember, 27 coins, I think something like that.
Around 27, 28, somewhere around there.
But we'll be adding to that in the future. Now, additionally, you can come over here and hit all coins, and you just get a full, this is your standard price information. So if you went to CoinMarketCap, this is exactly what you would see. All right. So we have the top 250 coins. The reason we've decided to start limiting it to the top 250 is because once you start getting out of the top 250, you're really looking at a lot of junk coins. And, first and foremost, what we do here isn't provide a website for looking at price data. We're trying to help people become better investors. And investing out of the top 250 oftentimes is a fool's errand in the crypto market. I'm not going to say that's always true. Certainly, a lot of people have made fortunes by doing that, but those people tend to be insiders, VCs, and the actual people running the various crypto projects. Okay, so once you get into these very small caps, you could just come up here and sort by market cap. You'll see that the 250th coin has a market cap of 122 million. Once you get below 100 million, the ability for people to manipulate these markets is just huge. So, it's going to be very difficult to kind of make profits in these coins. What we can also see is if we just, let's just get rid of the 7-day. Let's do the all-time high. Okay, so a lot of these are going to still be down 98, you just look 97%. A lot of these are just still getting crushed. Now, every once in a while, something like Frax Ether, it's doing okay. But the majority of them are down 80% or more still from their all-time high. That's not to say the large caps aren't doing the same thing, but a lot of these things are going to be, just coins without a use case, coins without any users. And that's one of the things that on my channel I preach all the time is you want to avoid things without users, without use cases. It's basically VC owned, it's basically founder owned, and they're going to dump on you pretty much every single time that the price pumps, unless it actually is a project that's just kind of unknown so far and really does have potential. But you have to remember these people that, they start these coins, they have marketing teams, and their entire goal is to make you believe that this coin does have potential or does have, serious use case in the market that's just being underutilized or just hasn't been discovered yet. That's usually not the case. So because of that, we kind of think that, the top 250 is a good place to start. If we need to add more as the crypto space grows and matures, then we'll do that. But for now, we're kind of right there. Just to quickly go through these things, we're releasing weekly, at least weekly market reports. So, right now we have 2 up. You can see that, we kind of discuss a broad range of topics regarding the crypto market. Mark just released this MDC backtest. And what this shows you actually is the backtest of using the MDC. So this particular metric, when the price crosses above the MDC level, it's a very strong buy signal. Conversely, when the price crosses below, it's usually a very bearish signal. And it kind of shows the results you would have since 2017, the middle of 2017, if you were to simply use the MDC and just using a plain MDC where you buy when it goes above, you sell when it goes below. Okay. So this is a very powerful tool. You can see that, if you started with $1,000 back in 2017, currently you'd be at 60K just using the MDC. And then so far, the last thing that we have on the site is any videos that we post, they'll come right here. So you can see that Mark and Joe recently posted an Algorand video, and that's there. So, this is all beta type stuff here. It's not the final product. We're going to be adding a lot more. Like we added this feature today that we're still messing around with. I think we're actually going to change this again, where you can sort by trade volume, you can sort by market cap. But what I'd like to do is make it so that you could sort by everything. Let's say you only want to view UDPIs that are above a certain level or below a certain level. So we'll be adding something like that so that you can really customize the site to whatever it is you want it to be. We'll also be adding a portion to the site soon where when you click on a coin, it will take you to something like this, but the chart will be a little bit different. And there will be additional information about the coin that you're looking at below it. on top of, you'll be able to see all of the different articles that we've put out about that coin, that kind of thing. So all the information about each particular coin that we've personally published will be right there all on one page for you. So we're really trying to make this a kind of a one-stop shop for all of your crypto needs. And, you know, like I've mentioned in all of the posts I made, if you guys have any recommendations, if there's anything about the site you don't like, you just let me know. And we try and accommodate, you know, as long as it makes sense to do so. It makes sense for, you know, a lot of people, not just like a single individual user issue that you might be having. And we'll try and accommodate that too, as long as it makes sense to do so. So that's kind of a very brief run through of the site. I don't know, Mark, do you want to add anything there?
No, I don't think so. I think that covers a lot of the functionality well. One thing maybe we can transition into talking about then is kind of how we can use the tools on the site to kind of interpret some of what's been going on in the market currently. Because I think there are a lot of really interesting things that you can glean from this that you wouldn't necessarily get elsewhere. Well, you definitely wouldn't get elsewhere, and you wouldn't, I don't think, intuit just by looking at some of the market moves. So maybe actually what I'll do is I'll just go ahead and share my screen with the website up, and I can just walk through some of the things, and we can discuss a little bit some of the things that we're thinking about. So one of the things that I like to look at when I'm looking at the dashboard is where kind of the market as a whole sits. So, you know, one of the things that's obviously useful is you can just look at, you know, for a given asset, you know, Bitcoin, where is it, for example, on its upside versus downside potential, or kind of its risk. So you can see with Bitcoin, you know, it's maybe getting a little bit overheated short term, but not too bad. You know, it's just poking above zero. You know, medium term is similar, long term is similar as well. So it's kind of near neutral overall. But what you can also look at is where does Bitcoin stand relative to some other assets? And so that's where I really like using the sort feature on some of these, because what I can really quickly do is say, okay, if Bitcoin and some of the others, so if I go the other way, so for example, Phantom, DOT, AVAX, XTZ, et cetera, if these might be getting a little bit overheated, and especially Phantom is looking, at least in the short term, quite a bit like that, sitting all the way up at 3 out of, you know, with 5 being the maximum. You know, maybe these aren't offering the best, you know, risk reward in the short term. Then what you can also do is you can flip it the other way and say, okay, then what are the assets that are sitting a little bit lower? And so you can see ones like, you know, XRP, eGold, BNB, and then interestingly, even Sand, which even had, though it's pumped quite a bit in the last, you know, month or so, still is sitting relatively low compared to other ones. And so that's the kind of thing where if you think the market's going to continue to pump, then, you know, do you want to go into the ones that maybe have already put in the majority of their move? Or maybe do you want to focus on ones that have more of a move to give should they decide to start pumping? So obviously, you know, it'd be up to you to decide what to make of that, or what strategies you might want to employ. But we've talked before, you know, on our channel, and Jay, I think you've talked about this as well on your channel, this idea of rotation, where in crypto, oftentimes what will happen is certain assets will pump early, they'll run early, and then other ones follow along later. And with something like a UDPI, it's really easy to identify which ones those are. You can identify, you know, something that's already gone kind of nuts and is probably near the end of its move versus ones that haven't done that yet, and that you might, you know, be able to get in early before that happens. This idea of kind of buying consolidation and selling the pump, kind of an idea. And, you know, I've done some back testing with the UDPI where I test strategies where you're basically doing that. You're monitoring multiple different assets. You're selling the ones that pump and get into the high levels of UDPI. You're buying the ones that are down low, and it outperforms, you know, just buying and holding, you know, that basket of assets. So that's another thing that you can look at that I think is really useful. And the final thing I'll mention with this as well is just looking at the proportion of assets that sit above or below zero on something like the short-term UDPI can be really useful. So for example, if you look at this, you know, the majority of coins, you know, most coins are actually above zero, which suggests potentially that the market is, you know, maybe not fully overheating, but it's starting to get more overheated. And one of the things that you'll probably notice is that if we get to a point where the vast majority of assets are sitting quite high on their short-term UDPI, or especially if their medium and long terms start getting quite kind of extended to the upside, that oftentimes coincides with at least local tops in the market. And I've actually shown this on videos on upside down data, where you can actually just average across all of these different indicators for all these different assets. And it actually acts very nicely as a more macro indicator of likely tops and bottoms. So, for example, spring 21, fall 21, you saw really overextended levels on average for the short, medium, and long-term UDPIs that were kind of indicating that the market was overheating at those points relative to lows in bear markets, which tend to be on average quite low. So that's another thing you can keep an eye on with this dashboard that, again, is hard to do on your own without a tool like this to really know how overheated is the market in aggregate. It's hard to do that without something like this where you can just very quickly go and look and see where things tend to be overall. So those are a couple things that I like to look at just with this dashboard page. There's obviously much more. That's literally just looking at the short-term UDPI and some of the insights you can get. There's, of course, a lot of other things you can look as well, doing that with all the other different models we have, like the market direction classifier, for example. If most of them are above that critical level, that means that the model thinks that most of these are in an uptrend. That tends to be in kind of bullish times in the market. You see a bunch of these start flipping red, that might be a warning sign that things are about to take a change in the market. So something that I like to keep an eye on there. So Jay, do you have thoughts on these things, on some of these interpretations, like things that you like to look at? And I can go ahead and stop my share if you wanted to pull up different things.
Yeah. So one of the metrics that, I'll just quickly show, it's one of the ones that I've commonly talked about. I've tweeted about this one. It's the MDC. And, I think this is a really powerful metric here that let's zoom in. So basically, if we just go back, there's lots of price history that is going to kind of show you the same thing here. But let's just, let me bring something up here. Let's just assume that, you started using the MDC back here in 2020. And sorry, give me 1 minute, guys. I'm trying to. Okay. So the way the MDC works is when the price kind of moves above this, you want to kind of get into the asset. And when it falls below, the price falls below the MDC, you kind of want to get out. So you'll notice that the price was above the MDC right here in we're talking 2018, right before the collapse, where it fell down to kind of down to 3,100. So the price was up here at around 67, almost 7K. And at that time, the MDC was above the price. So you would not have been in the asset at that time. You would not have bought Bitcoin. You would have been out of Bitcoin at that time. And you'll notice that what happened, it saved you from experiencing, whoops, that's way too big. It saved you from experiencing that huge crash right there, right? Because of the fact that it's saying that, hey, the price action right now, it's rather bearish, so you should likely stay out. And from there, what did it do? It told you to get in kind of right here. It said get in, and this was at a price of around, we were sitting at around 30, maybe 4K, just right at 4K, even below it, 3,600. And it got you all into that huge run that we saw where it went from 3,500 up to 13K. And what did it do then? It got you out at around 11K, 10.5K. So that was a 300% profit almost, while a lot of people probably kept holding, thinking that this was a traditional dip that we see. And those people kind of held all the way through the COVID capitulation event, right? So they would have bought back here, sometime down here with the MDC. They would have got out at around 10.5. The MDC did say back here in January that, hey, the market looks like it's going on another rally right here, okay? Right here in January, and I'll just zoom into that exact point. Right around here on January 6th, it said the market looks like it's starting to turn around again, right there. And the MDC said, this looks like a real rally. But the COVID occurred, the government shut down, or a lot of the government shut down the economic activity in various states, most of the states, in fact, and the markets crashed at that time. And so importantly, and I think this is huge here, the MDC is not always going to make you money every single time the price moves above it, but it corrects its mistakes in almost every instance. So the market turned back over after it was showing a bullish sign. The market turned back over, and you actually ended up making money in this instance. The point where it told you to get out was actually slightly above where it told you to get in. Okay. So, I'm just zooming in for you here. We're talking about right in this area here. So, you know, you made some money on this trade in spite of the fact that most people went on to hold as it dropped from around 8,900 all the way down here to around 4,900. So that's one of the powerful features of this metric. And then if you see once the market recovered right here in April at around what we were at around 7,800, it got you into the market and pretty much kept you in except for a short time here in January. And, it got you right back in again, making a profit because it put you out at around 3,600, but then told you to get back in at around 3,300. And then it finally got you out with some sideways chop where, it kind of would have been an in and out thing at around 40, almost 50K. So it basically told you to get in at 7,800 and told you to get out at around 50K. Okay. And importantly, if you look right here in May, when we all know what happened, China stopped allowing Bitcoin miners to operate in the country. It outlawed crypto for the 10th time. Elon Musk tweeted that, Tesla was no longer accepting Bitcoin as payment for its products. The MDC, and, I still don't think a lot of people are appreciating how impressive this is. The MDC said, maybe the market's going bullish right now. It's kind of tough to tell. We're kind of chopping sideways. But it said definitively right here on May 9th, just like the COVID capitulation event at 56K, it said, get out of the market. You don't want to be in the market right now. And what happened? The market crashed all the way down to a low right here of 35K and, a closing low. And it got you in right here at around 30. Sorry, the market closed low at 30K, and it got you back into the market at 30K and kept you in all the way until the price crash, when a lot of people were saying, hey, buy this dip. We're at 58K right now. The market's going to turn around. This is we're on our way to 75K, which is going to take us to 100K, which is eventually going to take us to 250K. The MDC said, nope, this is a bear market, or, the market signs look very bearish right now. So get out. So it got you in at 35K, got you out at 58K. I'd like you to ask yourself, how many of you got in at 35K and got out at 58K? I'm willing to bet a large amount of money that very, very few people, made that type of trade during this time, because there were so many mixed signals. The Fed was, the interest rate data was starting to come in, and it looked hot all through 2021. It looked hot, and the Fed's telling you that, hey, it's transitory. Janet Yellen's saying, this is temporary. Jerome Powell, this is transitory. And then in November, what did the Fed do? They said, hey, we're actually going to have to raise interest rates, right? And we're going to do multiple interest rate hikes. That's when the market tanked. And the MDC doesn't know that the Fed is making an announcement. It doesn't have access to that information, but the price data reflected that. It reflected that something is going on. And so the MDC is able to, kind of pick up on that information. And what did it do? It basically kept you out all the way. Like I said, there will be these little false starts, these little times where, it says, like right here in February, it says maybe this is a market rally. But if you look what happens, even if there's a false start, it gets you in and then gets you out at essentially a wash, a break even. To slightly, once in a while, you'll be up 1 or 2%. Once in a while, you'll be down 1 or 2%. But it's going to prevent you from going through these times in the market where the price goes from 58K all the way down to, what, we crashed all the way down to around 38, 35K right here in January, just about a month and a half later, or whatever it is, 2 months, right? So it keeps you out of these massive market crashes. In almost every single instance, we can go back as far as you want to go. And the MDC has prevented you from experiencing every single major market crash that the cryptocurrency market has experienced. And that's not being, that's not hyperbole. You can go look. It has prevented you from experiencing each and every single one of these market crashes. All right. So, I think this is a powerful tool. I mean, just look here in April. It got you out right here at 42K. The price was down to 22K. It got you out at, 42K, and the price was down here to, 19K just 2 months later. All right. So in addition to, I think making, being on the upside in crypto is easy. It's getting out of the market at the right times that's very difficult. And that's something that the MDC permits you to do. And you might be saying right now, oh, the taxes. Well, you're not going to be paying taxes if if you lose 50% of your money because you're sitting in these massive market crashes. And so, a couple of things you can think about when you're looking at a metric like this is you don't have to go all in or all out every single time the MDC kind of says, it kind of switches course. What you can do is kind of use that as a DCAing signal or as a profit taking signal, and not do it all at once, but kind of look and make sure that the market is going to kind of continue its trend. And just to finally wrap this up, what you can see is right now we crossed above the MDC. We're up around 33%. Maybe a bit less than that right now, from where the price crossed above right here. So this is, I think this tool is actually insane, and the fact that so few people are using it. I said on Twitter today that it's laughable how few people are using this, in spite of what a powerful tool it's demonstrated to have been. And personally, I use it, and I've been very successful in this market. With my own strategies. And when I saw this, it was like just a revelation, because this is a game changer, in my opinion. So I'll let Mark talk about, maybe there's more advanced strategies that you can utilize, but I think this tool, if you're not using it, I think it's funny because I guarantee some people watching this right now will look at this, and after this, they'll go watch a fib level video and think that that's giving them some type of profound information. So, it's not an insult to fib levels. I think they may have their use and their place, but I'd rather be looking at something that says on May 9th, get out of the market. And then on May 12th, the market's on its way down to 29K. So that's my piece about the MDC. I think it's an amazing tool, and I truly mean that. Mark, I don't know if you want to say anything there.
Well, yeah, for sure. So the MDC is a model that I've been very pleased with over its time. It's shown its ability, its predictive ability multiple different times, which is obviously what you want to see in a model. And I think the backtests really bear that out. That's part of why I wrote that article. If you haven't read it, I encourage you to go check it out. Where even just a very simple strategy where in that backtest, all you did was just watch the daily close. If the daily close was above the MDC level, then you buy. If it flipped above, you buy. If it flipped below, you sold. And you would have a foreign buy and hold by over 4x that move. So you also mentioned kind of more advanced strategies. So there's some other ones that I've been thinking about. I actually haven't tested these yet, but I will do some back testing, and I'll actually share those in videos once I have a chance to do them. But I'm just going to go ahead and share my screen again here just to kind of talk about what I think might be a different way that you could use the MDC if you don't want to use it just as a kind of a pure buy sell indicator.
Sorry, Mark. Let me, I think, oh, go ahead. Sorry. I thought this thing was in your screen. It's not. Sorry.
Okay. All right, cool. So yeah, so instead of it being just like a pure buy sell indicator, there might be some other ways that, could make sense to use it. So one of the ones that I've actually thought about is using the MDC as a way of kind of guiding how you interpret risk levels or the UDPI levels. And so kind of the context of this is in previous videos, we talked about strategies where you use the UDPI kind of to base a DCA strategy on, a dollar cost averaging strategy on. So dollar cost averaging is basically where you're just doing multiple buys into an asset spread out over time to try to catch an average price level that might be favorable. And then also you can DCA out of the market. You can kind of slowly sell out of the market to try to, capture an overall favorable price. And we've talked about, how you could just do that by simply just stratifying, the UDPI levels. So if we take, for example, the Bitcoin long term, you could say that anything above 0 is a sell, and so you sell more and more and more Bitcoin the higher up on the UDPI you get, with selling the absolute most up, and once you get up above 4 or something like that, and then buying more and more and more aggressively as you get down further and further, because these really low levels tend to correspond with low points in the market. But with the MDC, what you could do is you could say, okay, if the market seems to be overall kind of bullish right now, so I'm going to go back over here to the dashboard. But if you're just looking at the MDC and you're positive, you might say, should I start selling as soon as, that kind of more basic DCA strategy would tell me to? Should I really treat 0 as being neutral? Maybe I should actually treat 1 as being kind of this neutral point on the UDPI, where I actually would be buying up until 1, or maybe buying up until 0, leave 0 to 1 as neutral, and then start selling above 1. But then if I flip below the MDC, I'd maybe shift my frame of reference again, where when I'm below the MDC, maybe I want to be more aggressive in my selling, maybe actually treat something like -1 as being kind of that neutral point, and sell anything that's above, above -1. And so you could use the MDC to kind of weight your dollar cost averaging that you're basing on something like the UDPI, where you're treating different UDPI levels as being neutral based on whether or not the market seems to be bullish or bearish. Because what you probably don't want to do, or what you might want to avoid, is that if the market's about to go on this big parabolic rally, you'd want most of your selling to be all the way at the top here. And so by shifting that frame of reference, so let's say, for example, I only start selling at 1 because I'm above the MDC level, at this point in the market, then I would have not sold anything back here. I'd only slowly start selling out through here, then I sell heavily through here. And especially as the MDC level starts to get lost up here and the market's flipping more bearish according to the MDC, I'd be exiting out completely. So that by the time that this crash came that Jay was just talking about back here in May of 21, I should be basically completely out of the market because I've weighted my sells so heavily at that point I'd be out. Then likewise, as we come back through here and we flip more bullish again, you start DCAing very heavily early on in here, and then start selling out again through here as the market starts to heat up and you lose that MDC critical level. So I'm going to do some back testing to kind of test that out and see how well that works compared to just a normal DCA strategy against UDPI. But it's another one that I think is interesting. It would be one where it would require you to kind of pay less immediate attention to what's going on. You wouldn't have to catch every single flip above and below 0 on the MDC, like using it as a pure buy or sell signal. But of course, using it as that, at least historically speaking, has been profitable. But if this is also profitable, it's an interesting alternative strategy that you might be able to use. And then, of course, the benefit of having the site and having those data is that you can go and look for yourself and think about what other strategies might make sense. If there are other ways that could be to use these data that might be more beneficial. So obviously, those decisions are ultimately up to you. But those are some ways that I'm thinking about it here. So one thing I actually did just want to touch on quickly. So there was a question in the chat from Hold Russ, who asked about Link's long-term UDPI, and if it being relatively low means that might be a good kind of buy signal. So Link is number 2. It's the second lowest long-term UDPI right now. And so there are different ways that you can interpret this. So if you're talking about kind of more short-term rallies, so what we're seeing right now, if you aren't really thinking that this is going to take us off to all-time highs, for example, then I actually tend to look more at the short and medium-term UDPIs to give information about those, because that's what they're designed for. So the short-term UDPI is caring about moves that play out over days to weeks. So it's a much more short-term in its kind of focus. So it'll be basically reflecting or moving a lot more rapidly with shorter term volatility than something like the long-term UDPI, which is really trying to tell you kind of in the long term, so kind of multiple months time frame, what is the relative upside versus downside potential. So more macro. think about market cycle kind of thing. When is this likely the top of the market cycle, or when things are really risky in the market cycle versus unrisky? Whereas the short-term UDPI is going to be moving a lot more in the kind of intra-cycle volatility. And so what I think that this is really kind of telling us is that for Link, and frankly for a number of these different assets here, the model is still very bullish long-term in the sense that it thinks there's considerably more upside potential that's realistic than downside. Obviously the downside's there, you can't ignore it, but overall that's kind of what it's seeing. Whereas you can notice in the short term, it's actually a lot more undecided. It's close to neutral, where it's saying there's roughly equal upside and downside potential. So if the market conditions remain bullish, then Link could absolutely go ahead and realize some of that upside potential that exists in the short term. But also there's a very reasonable expectation, or it'd be very plausible for a Link to either have to cool off where it is right now, or maybe even actually correct a little bit. That would be, fully within what the model would think is reasonable. Because again, you're kind of near neutral. You're a little bit at the low side, so there's a little bit more upside than downside, but it's kind of roughly neutral. And so that's probably going to depend a little bit on what broader markets do, if Link will be able to do that or not. But really kind of the signals that are most strong on the short-term UDPI are things like, for example, Phantom right now, where it's possible Phantom will be able to move a bit more, but what the model is really thinking here is, at least in the short term, it's probably put in the vast majority of its short-term move. And the model would probably think it's most likely that Phantom will at the very least have to cool off for a bit before having to put in a move up. And you'll notice that if that happens, if Phantom starts kind of consolidating, cooling off, you'll probably see the short-term UDPI fall as well, as it might think that more upside is reasonable going forward from that. So I think when you're looking at these different timeframes, the interpretation just needs to be a little bit different. So that's kind of the main thing I wanted to focus on there, is that really with Link, it's kind of in the short term, it could go either way. Long term, the model has a more bullish disposition on it than bearish. It thinks there's considerably more upside than downside. That's realistic. So I just wanted to touch on that question as well. So Jay, I'll go ahead and turn it over to you if you have additional thoughts or other things you were thinking, either related with that, what I was just talking about, or other things that you're eyeing.
Yeah. So just one quick thing. Someone asked, and this is a question I get all the time. Am I going to put the DCA index on the website? And I've still not decided. Maybe at some point I will, but here's the reason that currently I don't necessarily think that's a great idea. The DCA index, if you plot side by side to the UDPI long, they're very, very similar. There are small, 10, if we converted the scale, Mark uses -5 to +5. I use 0 to 100. There's small differences, but overall they're extremely similar. And so because of that, it's kind of just redundant putting it on. And let me just pull up Bitcoin here. So right now the UDPI long is for Bitcoin is at a -5, which for that's a what is that, around 45 or so for the DCA index. I don't know, maybe there would be use in putting it on, but a large majority of the time they're going to be rather similar. So I'm still thinking about it, and I'll talk to these guys and I'll see what people want. But if you look over time, they tend to peak at almost the same exact time, and they tend to kind of bottom out at almost the same exact time. And so what we don't want to do is kind of create information that is going to lead people to confusion, or kind of giving them varying information that is ultimately going to make things more difficult. So if you've ever heard of the term paralysis by analysis, we don't want to kind of put that into people, where we're giving you so much information, and maybe the UDPI long is slightly different today than the DCA index. And so because of that, at the moment I don't plan on putting it on, especially considering it's already available on TradingView, and thousands of people have signed up for it at this point. That I kind of think that it doesn't necessarily make sense to put it on here, because when it's telling you almost the same exact thing that the UDPI long is telling you. It just, I don't necessarily see the point of putting it on. But, we'll talk about it and we'll see if at the end of the day, if everyone wants it on there, I guess maybe we'll do it, but only if it makes sense to do so. So we'll kind of continue to talk about that. And let's see, does anyone else, there's some other questions on here. Mark, maybe you were just reading one of them. Do you want to answer anyone's question and I'll take a look here?
Sorry, I was muted. Yeah, so I was actually just answering a question that Marcelo had posted, which is a good one, which is the strategy that you would use for the long versus short versus medium UDPIs different? I think that's a great question. I have back tested different DCA strategies with both, and the strategies tend to work similarly. But I think to get kind of the most out of each of those time frame models or the different versions of the model, you probably use slightly different strategies. So I was mentioning in the chat here that I think with the short-term UDPI, you probably want to be a bit more aggressive to really make sure that you're, catching the local lows and the local highs as much as you can and not getting kind of caught in between them. And so there, I think a more aggressive kind of DCA type of plan where instead of, probably more aggressive in the sense of buying and selling more often within a week, for example, versus just like once a week. Then also the amounts, kind of how quickly you're getting in out of the market, we probably need to be kind of more extreme than something like the long term, which is much more about kind of riding the entire market cycle from accumulating at the market cycle lows and then distributing at the highs. So I don't think I've put any back tests where I've done that on the channel, but I certainly can. That would be an interesting one to do alongside some of the other ones that I was other back testing I was talking about with like the MVC, adjusting how you're using the upside downside potential indicator for those decisions. So any other questions here that you wanted to tackle?
Yeah, so let's see. Yeah, I think something you should also consider is that you also have to kind of think about what your personal investment goals are. If you're someone who's a more of a short-term trader, maybe you've just sold all your Phantom or sold whatever portion of it. And I think both of our channels have made videos discussing potential distribution of buying and selling based on where these metrics are. Kind of the kind of thing where maybe you're selling 10% once it gets up for my scale. For the DCA index, selling 10% once you get up to a 60, and then selling an additional 15% once you get up to 70. And then finally, once you get into the 90 to 100 zone, kind of selling everything that you have, whatever's left. And, you could kind of watch some of those videos because that's kind of a nuanced discussion that we don't necessarily have time for right now. But the way that you can do this is if you're a short-term trader, well, you're looking at Phantom right now and you're kind of thinking that, well, the market overall, it's still kind of in a bearish place. We're at what was it, a 3? I don't remember exactly where.
Yeah,
Phantom
on the
was.
short term, it's up at around 3.
Yeah. So we're at a 3. Maybe it's time to kind of get out of the market right now. If we look at Bitcoin here, as an example, a younger version of Bitcoin, if we just go to the short, you can see that there are plenty of instances here where the market's not quite in a bull market yet. Take back here, for instance, right? The market's not quite in a bull market, and we kind of got rejected at around a 1.3 right here, and we kind of got rejected at a 1.5. So when the market's not quite bullish, so there might be a bullish swing that we're experiencing right now, ever since right here at the beginning of January. But overall, I wouldn't say that we're in a bull market. I don't think anyone would say that right now. So maybe you do take profits here. Maybe you do take profits or some profits for a Bitcoin that's at a 1, because you have to realize that relatively compared to other points of the compared to the overall distribution of this metric during the bear market, this is very high right now. From our low, we were all the way down here to almost a -5, and now we're positive. So I like to look at these metrics contextually as well. And so something you could even do is, just do something like put it on something like a 90-day moving average, right? You can see that this kind of smooths it out for you. This isn't necessarily a great way, especially for the UDPI short. So maybe something just shorter scale would make sense. But, that's definitely one of the things you can do to kind of see, just, realize the trend that you're in. We're in a defined downtrend. Now, downtrends have to turn around at some point, and maybe this is that turnaround. But ultimately, you kind of have to decide how you want to approach the market. So I think if you're more of just a long-term trader, then you're just looking at something like the UDPI long. So let's just quickly put that up. You're looking at this, and if you want to do the same, if you just want to do the same thing here, just put on a moving average. And this is just one way to look at it. I wouldn't necessarily like take this to the bank, but it just kind of just shows you what the trend is. And you can see that the trend is clearly down, but we're making a break, at least challenging the 50-day moving average that we hit back here in September. And so what we want to see is a turnaround here. And you'll notice that every time this starts to make a new higher high on some of these longer term moving averages, every time it makes a new higher high in relation to some of these prior peaks, that's when the market kind of turns around. So you'll notice that back here in August of 2015, we kind of broke above in December of 2015, and that's kind of right around the time when the market turned around, right? Same thing could be said for right here. So we made this this peak right here in September. When we broke above right here in April, well, it took a while. It took about a year. Yeah, about a year. But this was the start of the market turnaround right here. This break above, because this was the bottom, and we started to break above. So if this starts to make new highs, if this starts to challenge this high that we made in October or May, then that's when you're going to kind of see the market starting to move up. And that's when you can start thinking about, perhaps we're in a bull market. Perhaps this is the time that the crypto market is going to start its true recovery. But for the time being, we have to kind of be skeptical about everything that we're seeing. So that's kind of one of the ways that I'm thinking about this. And, Mark might be doing backflips over there as I'm looking at this metric like this, but I think that's one of the unique things about, working with someone else who might be kind of removed from the data creation, is they might have a different way of looking at it than, than, you've ever thought of before. I certainly know people have showed me things on the DCA index that I've, never conceived of, but, they've kind of looked at it in different ways and manipulated it in different ways and have created strategies that never occurred to me before. So.
Yeah, no, I think that's a really interesting. I haven't actually looked at it that way, but I think that's really interesting. And that's one of the things that I'm really excited about with the site and with the workbench. And then, as you mentioned, our plans to implement ways for people to share what they come up with. Is I think people are going to come up with all sorts of insights that, we haven't encountered, even though, I look at these things all the time, obviously. And, there's still stuff about it that I'm probably not aware of. And so I think that's really great. So maybe I was thinking maybe this now is a good time to transition to kind of more broader thoughts about the market. I see we've been getting a few questions related to some of those things. So maybe this is a good time to kind of pivot the conversation over to what we think about the rally that crypto's been seeing. Do we think that it has more legs to go in the context of everything that's happening in macro? Do we think that this is maybe going to be the local top? And we can also then dive into some of the questions that are a bit more general that have come up here as well. So I guess I can just give a brief kind of couple thoughts, and then I'll turn it over to you, Jay, to get kind of your thoughts of what's going on. So I think what's going on with the market now is quite interesting. And a lot of people have been comparing this to 2019. And though I'm not so convinced that we're going to be able to do a full 2019, I do think that a continuation of this rally is plausible. And the main reason I say that is I think it's possible we're going to see the stock market, and I mean, crypto is a risk asset, but risk assets generally have a decent time, at least for the next month, maybe two, where, I think we're kind of in this period where the possibility of this soft landing narrative is still there. I don't think we're at a point yet where the data is going to be there yet to really point to this being a recession looming, even though all the leading indicators are saying a recession is coming. All the ones that a lot of other people look for, like unemployment rates starting to rise, and some of those things are not there quite yet. They're not. There's maybe softening a bit, but they're not really at that point. So you can still make a reasonable argument right now that a soft landing could happen. And if that's the case, then markets, have no reason not to just go up. And historically speaking, it's kind of the period between when the Fed pauses, or right before into the pause, where you see the most move up in the stock market. And then when the pivot actually comes, that's when the stock market collapses, because that's when the recession actually happens. And the reason the Fed pivots is because they have to, because something really bad is about to happen. And so if you're waiting for the pivot to get bullish, you're waiting for the wrong thing, is when the pivot happens, it's actually probably going to mean that we're going to see a lot of pain. And so really my kind of base case, and Jay, I'm curious to hear your thoughts, is that I think kind of for the medium term, the next several months, I think up is maybe the path of least resistance relative to down for the markets. But I'm not at the point where I'm thinking that we're successfully avoided a recession and everything's just green light and we're going to all-time highs. I actually think that, maybe somewhat similar to 2019, we might have a decent rally, but then we're going to get that pullback. And then, not getting caught off sides, if that happens, is probably going to be important. And I think it would be in that scenario where, at that local top is when everyone would be saying, all right, we're in the clear. Everyone go buy everything now, dump all your money into the whatever altcoin you like. We're off to all-time highs. And then those people will get wrecked. So obviously that's very speculative. We'll have to wait and see how things play out. My thesis might change, but that's kind of one of my base cases, or one of the things I'm thinking is reasonably plausible going forward. So Jay, I'm curious to hear your thoughts of where we are and where we might go.
Yeah. So, I guess when we're at a place where we're at right now, like, I'm showing the Bitcoin price here, but that's just because the Bitcoin price is essentially a hyper reflection of the stock market. So when the Bitcoin price started to really rally, that was during a big rally, after the COVID capitulation event. Bitcoin is essentially mirrored the NASDAQ, kind of on steroids. So when we're in those upswings, it's huge. And then when it goes off the steroids, it kind of shrinks. And that's exactly what we've seen with the Bitcoin price. So I think this is a good reflection of the market. So the reason I say that is because, since November, the market has done really nothing but come down. And there have been no real relief rallies, not even the stock market. I mean, if you just look at like the NASDAQ, for instance, maybe I can even bring that up here. But if you just look at the NASDAQ, let's see, I'll just pull that up real quick here. So this is something we will soon have on our site, but for the moment we do not. So I'm just going to show you on TradingView. But when you look at the NASDAQ here, you can see that this market has basically been a nothing but down market, right? So let me put this on log. We've come down, we've come down, we've come down. And we've actually adhered right to this trend line where we've bounced off of it every single time we've come down. And, on Twitter, Twitter's has to be just like the worst place on earth for an investor that's ever been conceived, because you literally just have brainlets who have huge followings, and they just basically spout out the most simple information. And because it's simple, it's easily processed by the largest number of people. And so it seems like it's great information, but because we've come down and we hit this uptrend, people that have been, on Twitter saying, oh, you have to sell right now. You have to sell right now. Well, these trends, that yes, they may give you some information, but it's not going to necessarily save you or it's not, going above that trend line does not necessarily indicate a market rally. If we just come back to, to this cycle here, you had a similar thing where every time you came up and you hit this trend, you were rejected off of it. And then we went up, we broke through it. And if Twitter existed back then, I don't think it did. Twitter did not exist in 2001, probably. We broke above and then we went down another 50%. So these trend lines, and there's numerous examples of this. This is just one easy example because it's so well defined that I can show you. But these trend lines don't necessarily define a market reversal. So, kind of like what Mark said, just because we've went above this in the short term, there's a lot of things that could still play out in the economy that would sort of indicate to us that, hey, this might not be the bottom. Now, we have been, like I said, trending down and doing nothing but trending down. So this is our first relief rally. And quite frankly, it could be the turnaround. But when we're kind of in this situation where, hey, some things look good, some things look bad, the way to be a successful investor, and, I'm just drawing upon my personal experience, I can't do anything other than that. It's to not become sort of beholden to one particular thought and idea and saying that, I have it in my mind because this metric shows this, and, this data says this, that this has to happen. Because take a look at Europe. A lot of people thought this energy crisis was going to play out one certain way, and it turned out that it didn't exactly play out that way. And so when things aren't happening like you suspected they are, you have to be flexible. So do I think we're at the bottom? I don't know. We're at a very indeterminate point right now. And just remember that people think that this all has to play out in a single continuum. Like the market has to start to get bad, and then it has to continue to get bad and continue to get bad, and then snowball and get worse and worse and worse until we're just, wrecked. That's not necessarily how it has to play out. Maybe 2023, the market looks okay. Things are going all right. And then in 2024, the job data starts to come out and look like crap. It can definitely play out like that. So we get this kind of rally in 2023, and then it sort of falls out from beneath us in 2024. And like Mark said, people that keep talking about this pivot, they're not looking at the big picture. The pivot is not going to be a good thing for the market. It's not going to create a market rally. The pivot's going to happen when the unemployment rate is skyrocketing. Okay. So when you get this pivot that you've been told now for, 2 years, that this is a great thing, talking about 2022, people talking about the pivot, and then they'll continue to talk about it all through 2023. They're not going to pivot unless they have to, because the Fed has a lot of backtracking to do after doing 10 years of, decreasing interest rates, essentially, with a few times in between where they've been increasing them. But if you've ever seen the yield curve, or sorry, the Fed funds rate, it's on a perpetual downtrend. So in order to give themselves some ammunition in the future for when there is a financial crisis, they need to kind of reset things. So they're going to keep those rates up for as long as they can. And when they can't anymore, that's not going to be a bullish sign. I can assure you of that. So this is a long-winded way of saying that I don't know if we're at the bottom. And, anyone who's definitively telling you one way or the other, I don't think, they're probably, maybe some people do have strong convictions for XYZ reasons, but I think there's a, sort of a mix of data right now that should lead you to a place where you're kind of putting yourself into a wait and see position. And, that's kind of why I always suggest it's a lame thing to have to repeat over and over and over again, but dollar cost averaging, because you don't know when that market bottom is in. But I can sure as hell assure you that if you're waiting until 40 or 50K to be buying Bitcoin because, it's taking off, you're probably going to be ticked at yourself, because eventually I do believe that time's going to come. And so not having 20K Bitcoin, not having bought Bitcoin when it was at 17K, not having bought it when it was at 19K, hell, not buying it when it was at 30K. I think you'll eventually come to regret that situation. Now, like we've laid out tonight, there are alternative approaches. You could be using something like the MDC and kind of just operating that way, and that's totally viable. So, I kind of think there's a lot to look at, and so it's very difficult right now to say whether we're at the bottom. Maybe a local bottom, I would say. So, Mark, you have anything to add to that?
Yeah, no, I mean, I agree. I think anybody who's calling the bottom, I've seen this happen all the time now on Twitter, and it annoys me because people are all saying like, "Oh, this indicator has now called the bottom," and then it uses this local bottom as an example of the bottom, and I'm just like, this could age absolutely horribly. Come back in a year, and this could this local bottom could look like dream prices compared to what we're at, depending on what could happen. And so that's not, I'm not saying it's guaranteed. I think, it is possible that it's the bottom, but as you said, Jay, I think we're way too early. And so anyone who's taking a victory lap now, saying that, oh, I called the bottom, I think they're way premature and it's probably going to age.
Well,
it very well could age terribly.
They call the bottom, and then, or, they create these models and call the bottom. And then when it doesn't happen, it's just poof. I never said that. I never mentioned that. We'll never talk about it again. Just ignore that. Just ignore that. And,
right.
It's never mentioned again. Lengthening cycle theory. And,
right. Yeah.
And, it's just ignored and never discussed ever again. It's just into the ether. So,
yeah, people will always celebrate their correct calls and then just ignore their bad calls. Absolutely. So there was another kind of more general question that Shaq in the comments had put forth. So this is changing gears a little bit, but it's an interesting question. So basically the question was, if you had 100K, you could only buy Bitcoin or Ethereum for the next 2 or 3 years, which one would you choose between those two? So Jay, I'll let you start with that one.
Yeah. So this one's easy. It's all about your overall kind of where you're at in life, kind of how much money you have, and what your risk tolerance is. If you are interested in probably, and I say probably because I could be wrong about this, but if you're interested in probably having a safer bet, then it's likely going to be Bitcoin, but you're not going to have as high of an upside. And if you are interested in having something that's slightly riskier, they're both massively risky, which sounds absurd to people in the crypto market. Because if you're exclusively involved in the crypto market, what do you mean Bitcoin's the safest thing you can invest in? But, the downside in this market is massive, no matter what you do. So you have massive downside and you have extraordinary upside. But, if you just had to ask me, I would say it depends on your risk tolerance. And if you have a slightly higher risk tolerance, then go Ethereum. Now, I consider Bitcoin and Ethereum to almost be trade-offs with one another at this point. They both have massive market caps. Ethereum's is obviously lower. So I think it really comes down to, do you look at Ethereum or then like the next altcoin? Because that's where the real disparity comes. So, if you're interested in an even higher risk tolerance level, then you maybe start to look at something like some of these top tier altcoins that have really got hit in this cycle. I would mention though, I would kind of avoid some of the older generation, like the generation that came out at around the same time as Ethereum, because, and I'm not going to mention names here because I'd probably want to do a little bit more deep dive into their networks before I made a claim like this. But I think some of that 2017, 2018 generation layer one stuff, it's going to have a really tough time competing with Ethereum. So what I'm talking about are kind of like this newer generation of things that came out in 2020, because I think they tend to be faster. They tend to process more transactions. And I think we're seeing that is going to matter, because every time the network crashes, every time it can't process enough transactions, that's just like when you can't at the base level process enough transactions for a high transaction period, you have a problem because that's an uphill battle. You're always fighting. You're always trying to figure out how to push the network to getting that next marginal percentage out of it. Versus if you can just crush how many ever transactions are happening right now, even at high transaction peaks, and you still have headway above yourself, that's probably a better situation to be in. And, because ultimately what matters here, it's not, how many people are investing in these things. It's ultimately what matters is how many people are using these networks, because we're getting past the age of speculation. Now it's going to start to, I mean, we're still in that age, but it's going to come down to use case. Can you actually use this stuff? If you can't use it, it's eventually going to fade away. So you have Bitcoin, you have Ethereum, and then you can start looking at your altcoins. Okay, so it's just an example. I'm not suggesting that you go out and do this, but Solana, it's something that can process high TPS, that kind of thing. So that would be like one of the things in that next tier, or something like Aptos that just came out. Something like Aptos may go to zero, but it's one of those coins that also has the potential to, from even where it was at a $3 billion market cap, it may have fallen down some now. I didn't look today. That's the kind of coin that you could see do a legitimate 30x. Like Solana had an $80 billion market cap, I believe, at some point this market cycle. Aptos is one of those coins that, for a brief second in time anyway, in the next market cycle, could have that type of market cap. So, but it's risky because it may also kind of fade away, fade into oblivion, and do nothing. So you kind of have to weigh that continuum. And the longer it's been around and the more popular it is, the more likely that it's going to have at least some level of stability and some level of return in the next market cycle, because a lot of people own it and they'll probably buy more of it as the next cycle comes around. So it just kind of has a natural, it may not, make you a millionaire, but it will still be around. That's kind of how I view those things. So it's all a spectrum of risk that you're taking. And so as your risk goes up, typically your potential profits are going to go up. So it goes from Bitcoin, then Ethereum, and then on down the line into more established altcoins, and then into newcomers like Aptos or Sui that will be coming out, like that kind of thing. Or Sui. I don't know how to pronounce it. So, but yeah.
Yeah. I mean, I agree with what you said. And so I think, I don't really have a whole lot else for that question, because it is just all about risk tolerance in my view. And I mean, also, obviously, in the real world, you're not going to be in a situation where you have to pick and choose. And I think really, the kind of a reasonable way of approaching crypto for the last, multiple market cycles has been is kind of, if you own nothing but Bitcoin and Ethereum, you still were probably pretty happy with it. Just because you were, you're not out. You wouldn't have held anything down to zero, which you probably would have done if you were playing around with a bunch of altcoins and, gotten at the wrong time with the bear market. And then a lot of those ended up going down to zero. So I think a lot of people talk about kind of Bitcoin and Ethereum as being, it's sort of like the S&P 500 for crypto in a small way, because they're the biggest ones. They're the big players. And so if you're going to be looking at, the market, that's kind of the benchmark you have to be weighing everything against. And you kind of have to be, I think you have to be pretty nimble with altcoins to really reliably outperform that, especially over multiple market cycles, if you're not using anything to give you an edge. And so that's where I think tools like the ones that we have on the website can help, at least helping identify when those bearish periods are where, being in altcoins is probably not a good idea. But then also when, that rotation back in can make sense. And that's where I think it's really a difference in mentality, because if you're someone who's just planning on buying and holding, those kind of metrics, you might look at them, but if you're just never going to sell anyway, then, what would be the point of even looking at a metric if you're just holding forever? But I think that's an extremely risky strategy with altcoins, and ones that gets most people just completely destroyed. The diamond hands idea with certain projects that people can really form a close attachment to, really love them during the bull market, and then not be able to break that bias in the bear market and just end up losing everything. Even if you were up 10x, it doesn't matter if you end up, selling when the thing is close to zero. And so I think that's just another thing. I mean, this is pivoting into a different rant, but it is just a thing that I feel like happens way too often in crypto, and I really wish it wasn't so strong. Is this marrying two assets that people just do all the time? And I think there's a lot of social pressure on places like Reddit and on Twitter, where if you're get to be part of a community, then you can feel this kind of loyalty that you have to stay invested, that you have to keep holding on to it because you're a bad, X whatever holder if you were to ever sell. And how dare you ever even think about selling? In fact, you just be buying more and more. And as it goes down further, just buy even more and more and more, even if it's something that has no usage and very plausibly is just literally going to go to zero. And you see that all too often. And I just feel like it's the worst thing in crypto when people get stuck in that mode and they can't get out of it. And motivated reasoning just makes them just only look for information that supports that view of staying in it. And they just ignore the massive piles of evidence saying that they should be getting the heck out of there. So that's just kind of a different thing. That's just another risk in crypto that I see a lot of people falling into that I think is unfortunate.
Yeah, I think what you just mentioned is also kind of a byproduct of being a scientist yourself. You look for the reason why is it this way, that kind of thing. And it's easy, both of us in this case, coming from a science background, it's easy to kind of forget that if you don't have, a lot of people will have that natural inclination as it is, but we've been both trained, I guess, for years to question the reasons why, research why it is. And not everyone kind of has exposure to a consistent, or any consistent training that would push them to question why things are the way they are. So I think that's why you see so many people on Twitter and YouTube and Reddit kind of just looking for the natural confirmation bias. They just want to find any information that kind of supports whatever they believe. And that's why, so many of these channels that lead people astray consistently are able to grow like that because, people have just kind of never been exposed to that line of thinking, always pushing to discover the reasons that things are the way they are. And so it just leads them to believe kind of whatever information that they're able to find, because a lot of these people seem very knowledgeable also. It's easy to come up with convincing data to kind of support whatever argument you're making by just simply ignoring everything that doesn't support it. And I think that's what a lot of the trap that people fall into. I know in my Discord, for instance, again, I'm not going to name drop. I'll name drop left and right in the Discord though. So, but there's a certain channel that I just have a huge number of people that have come to my channel through word of mouth because that person just led people into absolute disaster. There's a couple people in my Discord that are just, absolutely in ruins because of the suggestions that this other channel made. And they're just suggestions that, if you have any level of experience in a market, you would know that just were very unreasonable things to assert. But they're confident, they have a fancy presentation associated with it, and it just leads people to absolutely getting wrecked. And I think that's one of the other benefits of both of our channels and a site like this is it keeps you grounded. When things start to get overheated, if you don't believe me, if you don't believe Mark, well, maybe you believe in, these are, AI models here. Maybe you believe in computers and data. I don't know. If you don't believe me and Mark, maybe you don't believe in this stuff. So, but when you start to see something like Bitcoin, the UDPI long, when it's saying, hey, we're at a 5's as high as you can go, right? Maybe we are at the top, and maybe in fact Bitcoin is not going to see. So I put a 5 on here just to kind of show you guys where the top is. Maybe we're in fact not going up to 250K, because if you just look here, when we look at the Bitcoin price, look how unreasonable that would have been to suggest that we're going to 250K. right? We were almost at the top of the risk bar here, and that's when we were at whatever it was, 60 or whatever, 56K or whatever it happened to be in that case. All right, and in each case, 20K was kind of the top of the line. So for these people to suggest, XYZ, we're going to 100K, we're going to whatever, 200K, whatever all the ridiculous numbers were, plan B or whatever that guy's name was, the most insane. I will name drop that. That guy's just so insane that it's like it's actually insane. That's to sit here and say that Bitcoin's going to $1 million because of some supply shock or something like that is utterly absurd. But he has a fancy presentation. He sounds like he comes from a legitimate background. All right. No one knows who he is, but he tells you that he comes from a legitimate background, like that kind of thing. So I don't know. It's kind of a rant. I think this space is a minefield. This YouTube and Twitter are an absolute minefield of crap. And unfortunately, for most new people, it's easy to step in it.
Yeah, absolutely. And one thing I did just want to add quickly with this idea of how even people who seem very knowledgeable get sucked into some of this stuff. Joe actually put out a video a while ago on our channel talking about the psychology behind this. And this is an actual thing where there's this effect where basically if you get to learn some things, so you're not a complete expert, but you maybe feel like you're an expert because you've learned about a project, maybe you know about some of the ins and outs of some of the technical details, then you feel like you know enough to make an accurate judgment about whether or not this is a good project or not. And if you come to the conclusion that it is, based on whatever, objectively limited knowledge you have, then you are, likely to just act on that because you think that you're being objective. You think that you have all the information, you're smart, you've beaten the market because this thing is going to go to the moon and no one else does, or, only the small, subset of people. And then you interact with them, if in the case of crypto, on Reddit and Twitter, and you kind of get in this echo chamber where oh, we're obviously smart and we all have done our own research and we know what's going on. And then it just leads people to, never being able to change their position, even in the face of, obvious evidence to the contrary. And so that's one of those things where, everyone says do your own research, and it's still, something that you need to do, but also be mindful that, what it means to have researched is something that people have different views of. And just because you feel like you've done your research doesn't mean you actually have. And that's where I think kind of this idea of hedging yourself is always important. Even if you feel 100% confident in something, always ask that question, really? Like, is that even reasonable?
Right.
For me personally, I'm never 100% confident in anything, even if I feel, emotionally like I should be. I'm cognitively not, because I know there's probably something I don't know that's out there that's against what I think is true. And so if I'm going to act on something, it's never really reasonable, at least in my mind, to ever act 100% because, you can't really ever be 100% certain of anything. Right. So I think that's just another important point that a lot of people like to be certain. Uncertainty is something that makes people feel uncomfortable. People don't like it. But the reality is with investing, uncertainty is kind of where you need to live. And I think, Jay, you kind of touched on that before as well.
And I think what you just said there exactly actually illustrates the problem with Twitter and YouTube much better than even what I described. For instance, someone just asked, what did they ask? Are we at the bottom? I don't think a reasonable, successful investor would say to you yes or no. I think a reasonable answer is, I don't know. XYZ suggests this, ABC suggests the opposite. And so my approach, given XYZ, is that I'm doing this. But if ABC play out, I'm going to do this. I think that's the approach a successful investor takes. And what Mark just said is that, living in that land of uncertainty isn't popular, because if I make a video right now that says, I don't know if we're at the bottom, and, let me type, imagine the headline of the video, I don't know if we're at the bottom, ? Maybe we're not. Maybe we are. Are you going to click that? No, you're going to click, we're at the bottom with the guy eating a Bitcoin, right? And, making a stupid face. That's what you're going to click. And people don't like to, because when you click on my video, or, maybe not you guys, but when you click on, most people, when they click on someone's video, they want an answer. They want the damn answer. That's it. They don't want to hear rationale behind, probabilistic occurrences, and what may happen based on this and that, and what may occur based on other things happening. They want to hear, this is what it is, this is what's going to happen, and this is why I'm buying, this is why I'm bullish. Or if it's a bearish sentiment in the market, they want to hear why we're so bearish right now. And I think a lot of people that are successful in the space, it doesn't matter if they're right or wrong. They just come out and they just come out strong and they say one thing. And then I always say in my Discord channel, I was suggesting to people since November of 2021 that the market looks bearish right now. This is concerning for me. This is concerning for me. And that didn't result in any subscribers. But when the market crashes, these guys with big channels come out and say, oh, this is bearish. It's like, no shit, it's bearish. What do you mean? The price just went from 70K down to, to 30K. And you're telling us right now it's bearish. You were just telling us it's bullish last week. But they had a thumbnail and, they're telling you with certainty some things going to happen. And kind of whatever the tides of the market are at the moment, they say that this is certainly going to happen. So I always say in the Discord, it's better, or you want to be right, but you don't want to be right too early, because being right too early means you're going against the market sentiment. And so following channels that are popular almost unequivocally, not in all cases, like I rag on them all the time, but I think Ben Cohen does actually take kind of a decent approach to the market, where a lot of times he's not coming out like, this is super bullish right now, or this is super bearish. So he's one of the few channels that I would say that does have at least a sensible market approach with, some other BS in there that I won't mention, but I think he has a sensible market approach anyway. Whereas other channels, screw it, name dropping, like IA, are just complete idiocy, just, nonsensical BS. I've made this mathematical model that involves dividing the market cap of Ethereum by the market cap of, I don't know, Bitcoin or Phantom, and calling that a model. It's it's a slap in the face to people like, like Mark and myself, who are making models. And, and they say that because X, Y, and Z, this is super bullish right now. So I think that, the idea of certainty and the conviction of people's certainty is kind of what draws people in. And good investors, I think most good investors will tell you that, you never want to, like Mark said, you never want to be 100% certain. You want to challenge your own beliefs and look for things that negate your beliefs. And, at least if you, even if you are 100% certain, like I'm certain that this is going to happen tomorrow, at least even with your certainty, have a plan for the opposite set of occurrences, because, like he said, there is no 100% certainty. So I think,
yeah, well said.
I think someone said one other thing that we could answer real quick. Maybe not. Maybe we did answer it. I can't tell. Do you think
was it the question about recession?
Oh yeah. Do you think we're already in a recession? Do you want to answer that, Mark? Oh, Cello, you don't have to do that, man.
Sure. I'll give my thoughts and I'll hand it over to you. I mean, for me personally with this question, so I hear people arguing about this a lot, and the way that I kind of think of it is I don't know how much I don't think the label matters. Let me put it that way. Like, I think that a lot of people get hung up on this idea of like, when do we officially declare a recession? Should we have already declared one? Should we have not? In some ways, I don't think that really matters, because I don't think the market is waiting for some official organization or body to do that. It's just going to happen. So that's the first thing, first reaction I have is I think with that, it doesn't really matter. It's more about kind of what's currently going on. And I think it also depends how you define a recession. I think if you define a recession as something that entails, a rising in unemployment rate, we're not there yet. The data haven't reflected it yet. Now, you could just say that's all lagging. And so you could say that, that's not up to date. And so that's going to come. But again, I don't know if really labeling that matters all that much either. I think more what's important is identifying when is the market going to react if we are going into a recession. Because, if you're looking at leading indicators, you would say a recession is coming. When exactly, who knows, but it is coming. And then really as the investor, you're just trying to see, okay, when is the market going to react to something like that? And that's where I think looking at things like what the Fed is about to do makes a lot of sense, because again, the Fed is actually a pretty darn good indicator of when you should get out of the market with their pivot. If you go back to the last two major stock crashes, the second the Fed pivoted is the second you should have gotten the hell out of there, because that's really when the bottom fell out of the market, and and then the bottom formed, shortly after that. So, I think it's a fair question, obviously. So I'm not trying to, dump on it. It's not a dumb question to ask. But for me personally, I don't pay that much attention, because I think the things that, I'm watching are more the things that the market's going to watch rather than some of those factors. So my base case is that I think a recession probably is going to come, just because all the leading indicators say it will. And so this time would be very strange if it didn't. But, again, not 100% certain about that. But yeah, I'm curious if you probably have more nuanced thoughts about this. That was a bit of a kind of a ramble.
I actually don't think I do. As far as are we in a recession, I don't. Um, at the end of the day, I feel like a lot of economic analysis right now has all kind of been obscured, or not obscured, but rather warped by the COVID event. Because if you look at the unemployment rate, for instance, it's very rare where unemployment peaks and then starts a downtrend and then would peak again so early right after. But because the situation right now is so unique, I think that things are happening right now that are, we have this thing that played out that just was completely unprecedented as far as the modern economy, and I think like a lot of other things that we've seen, they're going to happen in unique ways. And trying to determine right now whether we're in a recession, I think, is extremely difficult, or whether we're heading into one. So it's something where I'm just kind of there. Let's put it this way: there are people on you can watch YouTube. YouTube's actually a good place for actual. There are some real economists out there on YouTube. People that work in the private sector. I Public sector economists can kind of be. You don't necessarily know what, and I'm not one of these like anti-government people or conspiracy theorists, but you kind of don't know necessarily always what's kind of what they're thinking, or what their goals might be, or what their biases might be. Same with the private sector, but I like to watch people that have been successful in business and kind of see what their thoughts are. And you can find wildly conflicting opinions from very respected individuals. And so to ask me, I do, like I've said before, I have an economics degree, but that doesn't make me, an expert macro economist who's, been working in the field for 30 years. And you do have a lot of people out there that do have those credentials, and they don't agree right now. So to ask me or anyone else in the crypto space, I think, or anyone for that matter, I don't think necessarily anyone knows exactly what's going to play out over the next year or two. I think it may take longer to kind of for everything to play out than people are expecting. Like I said, everyone wants this series of events to happen on a continuum, but there can be intervening events. Like I said, maybe the market looks okay this year and then collapses in 2024 or even 2025. We just don't know. So I think there's just too much out there right now. The economy's too complex. It's too interconnected globally for me anyway, to analyze everything and give you any kind of answer with a great deal of certainty. Like Mark said, if you just want to go on history, which I think is as good of a way to do it as any other way, I think, like you said, the leading indicators are suggesting that we might be heading for a downturn. And people were declaring a recession at the end of 2022, or at the end of Q3 2022. So a lot of it's also semantics. What's a recession anymore? Who knows? The definition is very fluid, I guess. So I think that's probably a good place to wrap it up with a very wish-washy non-answer. So
Yeah, absolutely. Yeah.
yeah,
Well, yeah, thanks
I
for
don't
having me
think
on,
there
Jay. It's
were.
always fun to
Yeah, yeah,
chat about these things. And I hope folks go and check out the website. Again, polaritydigital.io is the URL for that. Great resource. Go play around with it. Totally free to access right now. So highly recommend go check it out.
yeah. And one last thing I'll just mention on the site, you just have to remember when you're using it that a lot of the stuff on here is, a lot of it's in beta test. So if something's not working yet, we're probably aware of it, but not everything. So if you encounter something that doesn't work or doesn't obviously work the way it should, just let us know. Like someone mentioned the other day that when the site's in like this, there's no scroll bar to kind of get over here. So that was something that I actually didn't realize because I have like a 49-inch monitor. So I always am looking at it at a slightly different way than maybe other people are. And I'm the one who did the primary UI design. So it may have been a little silly for me to be using this monitor to design the site, but there may be little oversights that I made because of that. So if you guys experience anything like that, let us know. Like these are completely in beta test. These have gone through like 5 different iterations now, and I'm still kind of deciding what's going to happen there. The workbench right now, I just want to mention quickly, we're going to be doing an upgrade to the way that the formulas work. So you'll actually be able to put in complex formulas, and I'll discuss that whenever that time comes. We'll be adding the community section soon. Hopefully I'm going to get Discord linked into the site, so you'll actually be able to go straight to the Discord from the site itself. And we'll be adding in the usability for the customization of the site. So you'll be able to set it up however you want, save it to your profile. So that's what we have upcoming. But some things may not be working yet. And if they're not, just let us know. It's, if you let us know, we'll get it fixed pretty much right away. We work on it every single day. So, just let us know and we'll make it happen. So I think that's it from my end. Mark, anything else?
No, I think that covers it well.
All right, guys. So that's it for this one. And let me see. Yeah, that's it for this one. Until next time, as usual,